Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of studying return on investment. Today it's the follow-up series. Okay, it's part 2 of our gold overview, so I give my thoughts on gold. So let's get straight into it without further ado. Today we're focusing mainly on how do we value gold. Okay, so for those of you who follow the portfolio and know a bit about me, you'll know that I'm mainly a cash flow investor. So what I like to do is I like to look at an asset and say, okay, this is the projected future cash flows of this business. We want to find the summation of that, discount those cash flows back to today's dollars, and find a net present value. Then we want to say, okay, well, can I buy it for less than the net present value of those expected future cash flows? And it works quite well, and that's what most of the core positions in our portfolio are based, or all of the core positions are actually based on that. So when it comes to gold, it might seem a little bit surprising, like why am I talking about an inert asset that doesn't provide any yield? How can you apply a discounted cash flow method to gold or any other asset that doesn't have a yield? And the answer, of course, is you can't. You have to use a different method of valuation. So that's what we're going to talk about today. I've talked about some of the reasons why gold is what it is and some of the history behind it. Today we're going to go after two main, what I believe the two best ways of coming up with an approximate valuation of as to the intrinsic value of gold, and they are with long-term correlations of real interest rates. We've spoken about that in our past video. If you don't know the difference between nominal interest rates, so the interest rates that you see advertised on TV, and real interest rates, you really need to understand that. So go and watch the first video, and suggest that you go and read as much as you can about that from other sources. And we're also going to look at looking at gold from its traditional purpose as being an anchor or a weight of the currency supply. Okay, so the paper notes being backed by a certain amount of gold. We're going to ask the question, well, if we were to return to historical averages or historical standards using a gold standard, in this case a shadow gold standard, what would that look like? Now, the central banks and the governments around the world don't have to necessarily advertise a return to the gold standard. They can use an approximation and have this sort of unofficial gold standard. Moving into the future with the way the world stands in terms of sovereign debt, it's looking more and more likely every day is there's going to be some sort of a currency reset, and we want to be looking out into the future, being aware of all these things and saying, okay, well, what would that mean for us as investors? So here's an overview of the last 5 years of the relationship between gold prices and real interest rates as a percentage base. This is the strongest correlation that gold has. Lots of people talk about different ways, different things and factors that move the gold market. Over the longer term, the one thing that has shown a strong correlation are real interest rates. And it makes sense for the reasons which I articulated in the previous video. If you've got a non-yielding asset, the only reason investors are really going to be interested in that is if they can't get better investments elsewhere, or if their current their savings, their paper currency supply is diminishing due to inflation, they have to put it somewhere, and they look for something that'll at least stay standard, okay, a hard asset that won't deteriorate in purchasing power, and that's a way that you can preserve the purchasing power of your savings over time. So as you can see in this chart here, as real interest rates rise, gold falls, and as real interest rates fall, gold tends to rise. What I've used there is the TIPS minus the TLT, which is a 20-year US bond. Real interest rates, as a recap, is the nominal interest rate minus its inflation or expected inflation. However, these ETFs track the prices, so we've got to reverse it. Okay, it's just a bit of mathematics. That's all it is. Moving on, I've taken the last year. Okay, so this is 1 year of real interest rates and what's the correlation looking like with the gold price. So with the long end of the yield curve there, you can see here they track each other quite closely in the corner, and now we're starting to see a bit of a divergence. So we're starting to see a bigger gap between movements in real interest rates and movements in the gold price. Okay, so what should happen is we shouldn't have this much of a gap you see towards, if you follow the cursor, the right hand side of the screen. There's a huge discrepancy there. It's around about a 20% discrepancy. Now, it may not come back to one-to-one. The reality of capital markets is everything is fluctuating because it's mark to market. But the point is, as you can see on the left side of the screen, there's a much tighter spread, And that's formed a real divergence over the last year. Real interest rates have gone up a little bit and gold has gone down, but we've formed this divergence. So if you were to say, just purely based on that, where real interest rates are at the moment and where the gold price is, we would expect a reversion to the mean roughly to the tune of 20%, which would, as of recording, imply a gold price of $2,144 per troy ounce. So that's one way that you could look at it. The way we're playing the gold market mainly in the portfolio is in gold miners, as they have leverage to the commodity. If we change the way that we're looking at real interest rates, and here I've used SHY, which is I think the 3 to 7 year, so they're a basket of bonds that go from 3 to 7 years, and we have the tips minus the SHY. There's obviously a shorter spread between the two, so that would imply a reversion of roughly 11%, leaving the gold price to settle somewhere around $1,975 an ounce. So it's currently trading just below 1,800 in the mid 1700s. So it'd be interesting to see. This is a strong indication, at least in the short term, that we should expect a little bounce in the gold price. So we've got I don't want to say a technical analysis. I'm not a technical analyst by any means, but we've got a fundamental reason and we have a short-term common sense reason and correlation that we can be quite dependent on, in saying that there's too much of a spread between real interest rates and the gold price, and we expect gold to bounce back, if for no other reason than pure reversion to the mean. Okay, here's where things get a lot more technical and mathematical. We've got, if we had to value gold using its true function as a cornerstone of the money supply, given all the currency that has been printed or digitally created over the last decades, but particularly over the last year, I think something like almost a third of all the M1 money supply in the United States has been created in the last year. So you think about a couple of 100-year history of the United States, and almost a third of their currency has been created in 1 year. That is a significant change. So what would that do to the gold price moving forwards if we were to move to this idea of a shadow gold standard? So what would you need to do? You'd need your inputs, which would be, you could use M0, M1, M2. It's just different ways of measuring the money supply. You choose the percentage that would be backed by gold in the new standard. So let's say central banks get together and they say, okay, people are losing confidence in our currencies. What are we going to do about that? Okay, we're going to have a special drawing right at the IMF, or we're going to have some sort of basket of currencies to give investors confidence to make the money sound again. We will have a certain percentage of it backed by gold. How much should that be? Well, historically, I think the lowest it's ever been and worked is 20%. It can be 100%, but it doesn't need to, because not everyone's going to be withdrawing their currency all at the same time. So 40% seems to be a reasonable approximation. And then we need to know, okay, well, how much gold officially is there in the world that is used for money? So not necklace or jewelry or dentistry or anything like that. How much gold bullion is there that we could use as money supply? Okay, now, rather than go through a very boring and tedious process of calculating it, what I've done is taken some work from the great man, James G. Rickards, and put his calculations of the implied gold price using those particular inputs. Okay, so that's where we get it from. And I haven't put them all in there. He's got a whole range, and you can do this yourself if you really have nothing better to do. I've said, what are the top three that will give us a range. So if we use US M0 at a 40% backing of gold, that will give us an implied price of 3 1/3, so $3,337 per ounce, which is obviously a big leg up from where we are now. Contrary to what the Americans believe, the US is not the only country in the world. So what if we put in the US, China, and the ECB, the sort of three biggest economies, if you want to view them that way, and use the M1 money supply at a 40% backing? That would be just shy of $7,000 per ounce. And what if you use the M2, so you went up a little bit and just use the United States M2 at a 40% backing? you'd be looking at $12,346 per ounce. That's what an implied price would be. Now, bear in mind, this was written in 2011. He's since updated his estimates appropriately in accordance with the increase in money supply that has occurred since then. And the numbers are now closer to $20,000 per ounce. As arithmetically correct as I'm sure that is, I just didn't really want to, it sounds very hypey, and didn't really want to put out a video saying gold could go to $20,000 an ounce or whatever the case may be. As investors, my personal take on gold for the portfolio is it's a bit of insurance, in the sense that if we do have some inflation, gold will perform very well in that environment, and we have access to good quality producers that are actually good businesses in and of themselves. So even if we don't get a moonshot with the gold price, the free cash flows, remember the cash flows that the companies are producing, yes, that's tied to the commodity they sell, in this case mainly gold, but the cash flows that Kirkland Lake, for example, are producing are phenomenal as they are. We're happy to buy them today at today's gold price, at today's all-in sustaining cost of the company. And so if the gold price happens to have this big upside, fantastic, we're laughing all the way to the bank. But we're not betting on that, okay? My own personal and family trust, I do own some gold bullion. It's just a bit of diversification for some of my savings. I've got my own little formula that I like to use. But without getting too crazy, it is interesting to look forward at the macroeconomic environment which we appear to be inheriting. And as a portfolio manager, I've always got to be thinking, okay, what does that mean for us as investors? How do I protect my copiers and my fellow investors? Looking forward, supply and demand at the end of the day will move markets. If you go to goldsilver.com, they've got all the charts in the world. They've got different ways that you can measure the value of things. So you can look at gold versus the S&P 500. You can look at gold versus real estate and how they diverge or are converging on historical means. So they have lots and lots of great stuff there. Highly recommend it. And if you look at the amount of precious metals the central banks have been buying up, if gold is this worthless, barbarous relic, why are all the central banks so keen on acquiring it? That would be a basic common sense question that I would be asking. And another thing to think about is traditionally certain institutional funds, your pension funds and so on, have always kept a certain percentage. I believe it's about 3 to 3.5% of assets under management in precious metals. And currently we're well below that historic mean. So I think it's around about 0.5% of the funds have their allocation to, or 0.5% of the assets managed by the funds are allocated into precious metals. What if that was a simply mean revert? So that would mean, hundreds of billions of dollars of capital flows flowing into the gold market, which would of course be buoyant and push the prices up. So these are the reasons why we own gold. What would change our mind, what would change my mind, is if we reverted to mean on all these things, if real interest rates started to rise, meaning inflation was dropping and government starting to be a little bit more fiscally responsible, then gold would be less attractive because we could get real rates on things like bonds and savings accounts. So when you start to see your saving account with a real interest rate, not a nominal one, but a real interest rate of around 5%, then I'm starting to sell my bullion and move it into those assets. Thanks very much for watching. I'll leave a link in the description. If you're interested in following me on Twitter, there's the handle there, the ROI channel. If you haven't checked out the portfolio on eToro, I highly recommend that you do. Give me a follow, and if you like the way that I invest, maybe you want to invest a small amount copying the portfolio. And thank you to those who have liked and subscribed the YouTube channel. I greatly appreciate that. I really need your help to be able to grow the channel. So if you do like the analyses and the videos and you want me to keep them coming, I'm relying on you to help me out there. Thanks very much for watching. As always, take no responsibility for the information in the videos. I'm just a guy that loves investing and speculating, so please do your own due diligence, don't be lazy. Other than that, I'm going to leave it there. All the best with your investing, and I'll catch up with you in a later video.